Beijing time, 9:23 a.m., December 26, 2025. Shanghai Gold Exchange. Physical silver, deliverable now, in your hand, $81.99 per ounce. New York at the same moment, $79.57. A $2.42 chasm between hemispheres. Not a mispricing, not arbitrage. The instant the world discovered China just severed the global silver artery. 4 days remain until the cut is permanent. January 1st, 2026. The date the planet wakes to find the metal that runs through every solar cell, every electric vehicle, every smartphone, every AI server farm can no longer cross borders freely. By the time this ends, you'll know whether the next 96 hours place you on the winning side of the largest commodity revaluation in half a century, or whether you watch the next 10 years from the outside as silver destroys every assumption about how commodity markets function. Rewind 8 weeks. Late October 2025. Silver trades at $52. Already remarkable, a 79% surge since January. But inside the London vaults, across Chicago trading floors, no one celebrates. They're paralyzed. October 30th, 2025. China's Ministry of Commerce releases Announcement 68. One page. Western financial press ignores it entirely. Effective January 1st, 2026, all physical silver exports from China require individual government licenses issued by MOFCOM. Not quotas. Not taxes. A licensing apparatus where the state decides case by case who exports silver and who doesn't. Here's why that sentence ends the market as we know it. China controls 60 to 70% of global refined silver supply, not mining, refining. Turning raw ore into pure bars deliverable to manufacturers, mints, investors. 15,000 metric tons annually flow through Chinese refineries. 6,000 tons export to the rest of the world. 6,000 tons. That's the float. The buffer keeping global markets alive. London sources from China. India sources from China. The United States pulls substantial refined silver from China. January 1st, that pipeline converts to a discretionary valve controlled by the Chinese Communist Party. October announcement. Muted initial reaction. Silver climbs $3, then retreats. Analysts publish reassurances. Negotiating tactic. Trade war leverage. Licenses will flow freely. They were catastrophically wrong. Mid-November. First reports surface from Shanghai. Refineries exporting for decades. Applications under indefinite review. Small and mid-sized exporters shut out completely. Only state-owned giants with direct ministry ties receive preliminary approvals. Even those approvals carry conditions. Export only to approved nations, only for approved uses. Report every shipment within 24 hours to the government. This isn't licensing. This is a choke point. The market begins to understand. November 28th. Thanksgiving in the United States. Silver breaks $60 for the first time in history. The COMEX, New York's benchmark exchange, experiences what they call a cooling system malfunction. Trading halts for 6 hours. 6 hours during a historic breakout, during a supply crisis. People inside these institutions know modern exchanges don't just fail. These systems survive wars. A 6-hour halt during a delivery squeeze isn't technical failure. It's controlled intervention to stop a cascade. Early December. India, second largest silver consumer globally, imports 1,700 metric tons in a single month, more than a typical entire quarter. Indian jewelry manufacturers, electronics firms, investors, all understand what's coming. January 1st, Chinese silver flow to India stops or becomes subject to Beijing's discretion, so they buy everything available. Paid premiums of $5 to $7 over global spot. Airlifted silver from Shanghai and Hong Kong drained Shanghai gold exchange vaults by 75% compared to 2021 levels. Not just India. December 10th, reports emerge of a major hedge fund, managed by a billionaire whose name sounds like Paul Tudor Jones, placing an order for 1,400 metric tons of physical silver, more silver than exists in all registered COMEX vaults combined. The order, multiple brokers, targeting late December and early January delivery. Price willing to pay any price. Instruction: acquire the metal before China's door closes. This order, if real, represents $4.2 billion at current prices. The market couldn't fill it. Brokers approached London. No inventory. Zurich. No inventory. New York. We can offer futures contracts, but physical delivery takes 6 to 8 weeks. 6 to 8 weeks after January 1st, after licensing takes effect. The billionaire refused. The order remains unfilled. That unfilled order now hangs over every bullion bank's throat like a suspended blade. December 12th. Something extraordinary in China receives almost no Western coverage. The UBSSDIC Silver Futures Fund, the only pure-play silver vehicle for Chinese retail investors, experiences a trading halt. The fund surged 60% in 2 weeks. Retail investors piling in, betting export restrictions drive domestic prices vertical. They were correct, but the fund's market price disconnected from underlying futures value. Premium hit 20%. Investors paying 120 yuan for a fund holding 100 yuan of silver futures. Classic mania signature. Chinese regulators panicked. Halted trading for an hour. Reopened with new subscription caps. 100 yuan, down from 500. Attempting to cool the frenzy. You cannot cool a frenzy when the fundamentals are incinerating. Mid-December. China's physical silver market enters backwardation. In normal commodity markets, immediate delivery costs slightly less than future delivery. Storage, insurance, financing costs mean traders pay more for contracts delivering in 3 or 6 months. Backwardation flips this. Immediate delivery costs more than future delivery. Why? No physical metal exists. The market pays premiums for silver today because waiting means you might not get it at all. December 2025. Chinese silver futures for March 2026 delivery trade at $74 per ounce. Physical silver in Shanghai trades at $82. An $8 backwardation. This isn't a market. This is panic in price form. December 23rd. Silver hits $70 on the COMEX, new all-time high. Shanghai closes at $78.49, an $8 premium. December 24th, Christmas Eve. COMEX pushes to $72. Shanghai hits $80.15, more than $8 gap. December 26th, day after Christmas. Western markets reopen half-day. Silver explodes. $79.57 per ounce. Up over $7 in a single session. Up 9.6%, a 170% year-to-date gain. Best annual silver performance since 1979, when the Hunt brothers attempted to corner the market and drove prices to $50 before regulators rewrote the rules and crashed it. But this is not 1980. This is not speculation. This is not leverage. This is a physical supply crisis driven by the planet's largest consumer and refiner deciding to lock the door. Why China is doing this matters because the why determines what happens next. Silver isn't just precious metal. It's the most conductive element on Earth. More conductive than copper, more conductive than gold. Irreplaceable in high-efficiency solar panels. Each panel uses approximately 20 grams of silver paste, creating conductive pathways for electricity. China is building 700 gigawatts of solar capacity. That requires billions of grams of silver. China manufactures the most electric vehicles globally. Each EV uses 25 to 50 grams of silver, 67 to 79% more than traditional internal combustion vehicles. Companies like BYD research silver-based solid-state batteries, potentially using even more. China produces 90% of global solar panels. China produces 60% of global EVs. China has decided their domestic industries, their green energy transition, their technological dominance outweighs supplying silver to the rest of the world. Resource nationalism. The same strategy China deployed with rare earth elements in the 2010s. Cut exports. Watch the rest of the world scramble. Watch prices explode. Secure domestic supply chains. Geopolitical dimension cannot be ignored. November 2025. The United States government officially classifies silver as a critical mineral. Direct response to Chinese supply chain control concerns. The Biden administration's final months issue an executive order encouraging domestic silver mining and refining. The problem: bringing a new silver mine online takes 5 to 10 years. Building a new refinery takes 3 to 5 years. China has a 40-year head start. The United States cannot catch up in time. Europe cannot catch up in time. China knows it. Final 4 days before shutdown. Across the United States, bullion dealers either suspend sales entirely or list premiums of $15 to $20 over spot. A silver eagle coin normally selling for $3 to $5 over spot now lists at $95. For 1 ounce of silver, that's a $16 premium. What? Dealers cannot hedge. When you sell silver to a customer, you immediately short a futures contract to lock profit and eliminate price risk. But if you short a contract today and the market gaps $10 higher January 2nd because Chinese exports vanish, you lose $10 per ounce. Multiply by 10,000 ounces. You're finished. Dealers protect themselves the only way possible: price in the risk or shut down entirely. JM Bullion, one of North America's largest online dealers, 73 products out of stock. SD Bullion, another major player, pre-sale only. Place an order. They have no idea when they can fill it. This isn't liquidity problems. This is physical shortage. London, even worse. The London Bullion Market Association, global clearinghouse for precious metals, held 31,000 metric tons of silver in June 2022. By March 2025, 22,000 metric tons. A 30% decline. December 2025, drawdowns accelerate. Lease rates, the cost of borrowing silver overnight, spiked to 8 to 9%. Normal market lease rates, near zero. When lease rates hit 8 to 9%, no silver available to borrow at any reasonable price. The vaults are empty. The float disappeared. When the float disappears, the entire pricing mechanism shatters because global silver markets aren't based on physical supply and demand. They're based on derivatives trading, futures contracts, options, swaps, paper instruments referencing physical silver, but not requiring physical delivery. The system is designed to avoid physical delivery. 99% of futures contracts settle in cash, not metal. This works beautifully as long as everyone agrees to play by the rules. December 2025, the rules broke. Total silver mined globally each year, approximately 1 billion ounces. Of that, about 500 million ounces available for investment and monetary demand after accounting for industrial consumption and jewelry. But total silver traded on COMEX and derivatives annually, over 100 billion ounces. 100 billion paper ounces referencing 500 million physical ounces. A ratio of 200 to 1. For every physical ounce in a vault, 200 paper claims on that ounce exist. As long as only 1 out of 200 people demands delivery, the system works. 2025, that ratio shattered. 10 out of 200 demanded delivery. Then 20 out of 200. The vaults emptied. This is not market failure. This is design failure. The system was never built to deliver physical metal. It was built to create the illusion of liquidity while concentrating ownership among a very small number of institutions. Now, with China cutting supply, the illusion collapses in real time. Next 4 days and immediately after January 1st. December 28th, tomorrow. Final business day before New Year holiday in China. Shanghai Gold Exchange sees one last wave of physical withdrawals. Every industrial buyer, Every manufacturer, every speculator with ability to pull metal from Shanghai will do it. This pushes Shanghai premium even higher. We could see $90 per ounce in Shanghai while New York trades at $79.57, a $10 gap. December 29th and 30th. Western markets thin, low volume, skeleton crews. This is where real danger emerges. If a major buyer places a large order during thin trading, price won't rise smoothly. It will jump. We could see silver at $85 or $90 by New Year's Eve, not because of fundamental news, but simply because no one is there to sell at $80 or $82. The market will skip those prices entirely. Then comes January 1st. Chinese licensing regime takes effect officially. What that means in practice: any Chinese company wanting to export silver must file an application with the Ministry of Commerce. Application must include destination country, end user, quantity, purpose. Ministry has up to 30 days to review. 30 days during which no silver moves. Even if approved, the exporter must report every shipment real time to the government. And the critical part: government can revoke the license at any time for any reason. This gives China total control over global silver flow. If the United States imposes new tariffs on Chinese goods, China can retaliate by cutting silver exports. If Europe passes legislation China dislikes, China can cut silver exports to Europe. Silver has been weaponized. January 2nd, global markets reopen after holiday. First thing traders do: check Shanghai price. If Shanghai gapped to $90 or $95 while Western markets were closed, COMEX has to catch up. That gap, that instant repricing, triggers stop-loss orders, automatic sell orders placed by traders betting price would fall. When stop-losses hit, they convert to market orders, buy orders executing at whatever price is available. But early January, many senior traders still on vacation. No liquidity exists to absorb those orders. Price won't rise smoothly. It will spike, could go from $79.57 to $100 in minutes. Not because of new demand, simply because market structure is broken. Second scenario, even more dangerous. What if China doesn't issue any licenses the first week of January? What if the Ministry of Commerce stays silent? No approvals, no denials, just silence. In that scenario, global market operates on the assumption no Chinese silver is coming, ever. The shortage, estimated at 2,500 metric tons per year, suddenly doubles to 5,000 metric tons. Industrial buyers panic. Solar manufacturers in Europe and the United States bid against each other. They don't care about price. They care about securing supply before production lines shut down. A single solar panel factory can consume 10 metric tons of silver per month. If they run out, they lay off workers, miss delivery deadlines, breach contracts. So they pay whatever it takes. When industrial buyers enter the market with that urgency, price doesn't stop at $100. Doesn't stop at $120. Goes to wherever the pain is great enough that someone gives up. In a market critical to global energy transition, to electric vehicles, to artificial intelligence, that pain threshold could be very, very high. One more layer almost nobody discusses. Gold. December 26th. Gold hit $2,532 per ounce, all-time high, up 72.95% year to date. Largest annual gold gain since 1979. Same year silver had its best year. Not coincidence. Gold and silver move together during monetary crisis, when central banks buy, when investors lose faith in fiat currencies. The gold to silver ratio, how many ounces of silver by 1 ounce of gold, compressed dramatically in 2025. Started the year at 90 to 1. Now at 57 to 1. Silver outperformed gold by massive margin. Historically, when the ratio drops below 50, it signals major silver revaluation relative to gold. 1980, during Hunt Brothers squeeze, ratio briefly touched 17 to 1. If that happened today with gold at $2,500, silver would be $147 per ounce. Even a more conservative crisis ratio of 35 to 1, seen during 2008 financial crisis, puts silver at $71. Wait, gold at $2,532 divided by 35, $72. We're already there. But analysts keep citing higher targets. $100, $129. That $129 figure keeps appearing. Bank of America just raised their 12-month target to $100. BNP Paribas says silver could hit $100 by end of 2026. Independent analysts call for $200 to $300 within 6 months. Not fringe voices. Institutions with billions under management, all saying the same thing. Supply deficit is real. Chinese restrictions are real. Price must rise until demand is destroyed or new supply comes online. Neither happens in 2026. If you own physical silver, do not panic sell. Do not place stop-loss orders in the market because algorithms hunt those stops during thin trading days in early January. If you see price drop $5 or $10 in a flash crash, understand flash crashes in thin markets aren't real price discovery. They're technical artifacts of a broken system. Your physical silver, metal you hold in your hand, hasn't changed in value because a computer in Chicago executed a trade at the wrong price. Value of your silver is determined by its utility, its scarcity, and the faith people have in the monetary system. On all three counts, silver becomes more valuable every day. Hold your metal. Wait for clarity. Do not trade the volatility. If you don't own silver yet and you're trying to buy, understand premiums aren't coming down. Dealers won't magically restock in January. If anything, situation worsens before it improves. You may pay $90, $100, even $110 per ounce to acquire physical metal. You may wait weeks or months for delivery. But if you believe silver reaches $129 or $200 or higher, paying $90 today remains sound. The premium you pay now is the cost of certainty. Cost of owning something real, something that cannot be printed, something that cannot be debased. In a world where governments create trillions of dollars from nothing, that certainty has value. The brutal truth few say out loud. We are living through the transition from a debt-based monetary system to a commodity-backed reality. For 50 years since Nixon took the United States off the gold standard in 1971, global financial system has been based on a simple premise. Currencies backed by nothing except government promises. As long as people have faith in those promises, system works. But faith is not infinite. When you print $10 trillion in 2 years, when you run $2 trillion budget deficits every single year, when national debt exceeds 120% of GDP, faith cracks. People look for alternatives. Gold, silver, Bitcoin, real estate, anything that cannot be printed. Silver, because it's both money and industry, because it's required for energy transition and technology revolution, sits at the absolute center of this shift. China understands this. That's why they're locking down silver supply. Russia understands this. That's why they bought $1 billion of gold and silver from China in a single transaction in November. BRICS nations launched a new currency in October called the unit, backed 40% by gold and 60% by a basket of currencies. Not speculation, official policy. The world is remonetizing gold and silver. When gold is remonetized, silver follows. Because silver is the poor man's gold. The metal allowing ordinary people, small nations, retail investors to participate in the same wealth preservation strategy central banks and billionaires use. And silver supply is far more constrained than gold supply. 4 days remain before the door closes. 4 days before China implements the most significant export restriction on a critical mineral in modern history. 4 days before global silver markets operate without free access to 60 to 70% of refined supply. What happens in those 4 days and the weeks that follow will be studied by economists and historians for generations. This is not a trade. This is not speculation. This is a structural break in commodity markets. The moment when paper and physical separate forever. The people positioned on the right side of that separation, people who own actual metal, will benefit in ways difficult to comprehend.